This week we're talking about doing adjusting accounts for financial statements. And I know I've kind of hinted at this, I think, already with you, because we were talking about, you were asking me about like what happens when we use supplies, or what happens when we use up the prepaid insurance, right? You guys were asking me that. So this will help answer some of that, what we do in that case. The accounting period. So oftentimes companies, depending upon the type of organization it is, they use different types of accounting periods. So for example, at Merced College, I believe it is, they have to report things quarterly. Or you'll hear on the news, sometimes you guys will watch the news and they'll say, well, Nike reported their quarterly earnings, you know, they had net revenue of such and such $1 million. Okay, so that's quarterly. So a lot of your bigger businesses or some of your government entities, they will report things on a quarterly basis. A lot of small businesses will report things on a monthly basis. They'll do that. You have semi-annually, which would be a 6-month period, and then of course annually, which would be annually. And then one thing to note is a lot of times too with businesses, they won't necessarily go from January to December. They might start, for example, at Merced College, we have a fiscal year, and it probably starts in July. So it's July to June, because that would be what would follow our academic year. Okay, so there's different ways that businesses report their information. And I'll just go ahead and read this. It says to provide timely information, accounting systems prepare reports at regular intervals. So this would be when we prepare our balance statement or income statement or our owner's equity, etc. The results in an accounting process impacted by the time period or periodicity assumption. The time period assumption presumes that an organization's activities can be divided into specific time periods such as a month, a 3-month quarter, or a 6-month interval or a year. Most organizations use a year as their primary accounting period. Many organizations also prepare interim financial statements covering 1, 3, or 6 months of activity. Reports covering a 1-year period are known as the annual financial statements. So for example, in fact, I don't have one handy, but for example, a lot of companies, they'll release their annual report. So for example, I have a lot of stocks that I'm invested in my retirement, in my IRA account. So for example, ACTG, they will send me an annual report every year that covers what they did in the previous year. Okay, so their financials. And oftentimes too, that if the annually and when that happens, it also has to do, of course, when they do taxes. So if it's like a sole proprietorship or a partnership, they're going to do taxes January through December, because that's how we do it, you know, for the IRS. If they're a corporation, they can choose, it may vary then, and they can choose when they do their reporting. So for businesses, you can either work on either an accrual basis or a cash basis. So a lot of your bigger businesses, they will work on what's called an accrual basis, is when the revenues are recorded when the products or services are delivered, and they record the expense when it is incurred. So again, the college works on that at an accrual basis. Save Mart, I'm sure, works on that an accrual basis, okay? Because they want to record the revenue when the sales are being done, and they want to record the expenses when they're being incurred. Now, a lot of your smaller type businesses, they work on what's called a cash basis. That is when the revenues are recorded when cash is received, and expenses are recorded when the cash is paid. So for example, with what me and Mom do with Avon, we pretty much work on the cash basis. We have sales, and then we deliver products. When we deliver products, we receive cash. That day, I put the cash in the bank, and then I record that, and then I pay Avon then for the product. okay, and then pay any other expenses that we have. So it's done. The revenue is recorded when the cash is received, okay? And then they say most agree that accrual accounting better reflects business performance than the cash basis does. Accrual accounting also increases the comparability of financial statements from period to period, because there might be times when you've rendered a service but you aren't paid for it right away, and so that would affect when that would get recorded. If it's accrual, it's going to be recorded the same time that the revenue was generated. If it's cash basis, it's going to be when that cash is received. And if you're not paid 30, 60, 90 days out, that's going to affect when you're going to record that based on which system you use. So we see here, for example, on the accrual basis, $100 of insurance expense is recognized in 2019 because they had 24 months of insurance and they paid the full amount December 1st of 19. So you use 1 month of it then, and then for 2020 you're going to use 1 month of it for each month, so $1,200 of that for each month. And then in 21, then for January you're going to use 11 months of it. So you use 1 month of it in 19, 12 months of it in 20, 11 months of it in 21. The expense is then matched to the periods that were benefited by that insurance coverage. So that's the accrual basis. Now the cash basis, then, what you would do, and we see here on December 1st of 2019, Fast Forward paid $2,400 cash for the 24-month insurance policy. So if you used a cash basis, that entire amount would be recorded as an expense for 19. You wouldn't have to worry about it in 20 or 21, even though that's what is being covered. And you can see then that that would affect your net income numbers because you're not recording that expense for 20 and 21, even though it's something that's involved in that time, because you've already expensed it in 2019. And it makes 2019 maybe seem artificially low. So that's something, again, to be aware of, how you do things. And again, it's going to be based on the organization and what type of organization it is. So recognizing revenues. The revenue recognition requires that revenue be recorded when the goods or services are provided to customer and at the amount expected to be received from customers. The revenue recognition principle requires what I just read. Now, a major goal of the adjusting process is to have revenue recognized, reported in the time period when the services and the products are delivered. And so that's why we have to do the adjusting entries if we're using the accrual basis. Okay, so we'll talk about that. And then again, recognizing revenues. The matching principle aims to record expenses in the same accounting period in which the revenue that are recognized as a result of those expenses. This matching of expenses of the revenue benefits is a major part of the adjusting process. So again, we looked at that example earlier with the insurance. You want to be able to record that then for each month how much you used. And so if you're doing it on the accrual basis, you can then match the expense then to each month. And in order to do that, we have to do adjusting entries in order to do that. And so there's 4 major types of adjustments for transactions that extend over more than one period. So you have deferral of expenses, deferral of revenue, accrued revenue, and accrued expenses. And so the adjustments are made in a 3-step process. So first you have to determine what the current account balance equals, and then you have to determine what it should equal, and then you record the adjusting entry to get from step 1 to step 2. And so an adjusting entry is made at the end of an accounting period to reflect a transaction or event that is not yet recorded. Each adjusting entry affects one or more income statement accounts and one or more balance sheet accounts, but never the cash account, because we've already paid cash for these usually, or we've received cash for these usually, or we haven't yet, So we don't have to adjust that. We do have to adjust some other things. Again, this is kind of getting to our prepaid insurance, our prepaid rent, also supplies, right? We buy supplies maybe at the beginning of the year. We're going to maybe use those supplies for the next 3-6 months to a year. So this is how we take care of that. Prepaid deferred expense. Again, the prepaid expenses are assets paid for in advance of receiving their benefits. And again, examples are, as we've discussed, the prepaid insurance. Prepaid rent is another one. Oftentimes, maybe you'll pay your rent maybe up for 6 months, or maybe even up for a year. And then, of course, supplies, you buy them at the beginning and you do that. And so for all adjustments involving prepaid expenses, we increase or debit an expense account and reduce or credit an asset account, but never cash. So for example, with that one, we would have to debit an expense account and then credit the, say, prepaid insurance, or credit prepaid rent, or credit supplies, depending on what it is. So let's look at an example. Determine the current balance. Fast Forward paid $2,400 to cover insurance for 24 months that began on December the 1st of 2019. And then Fast Forward recorded the expenditure as prepaid insurance on December 1st. So they credited cash for $2,400 because they paid cash, and then they were able to debit prepaid insurance because that's what they received. As time passes, the benefits of the insurance gradually expire, and a portion of prepaid insurance asset becomes an expense, as we said. For instance, 1 month's insurance coverage expires by December 31 of 19, right? Because they're going to use 1 month worth in 2019. That expense is $100, or 1/24th of $2,400, and that's going to should leave $2,300 of prepaid insurance that they have to use for to use in 2020 and in 21. Go ahead and have to debit the insurance expense in order to recognize the amount of insurance that we've used, and then we credit prepaid insurance $100 in order to reduce the balance of it. So then right now, if we looked at this, we knew that we had $2,300 of insurance left, which is step 3. So we see then that the adjusting entry to record the expense will reduce the asset. We talked about that. Now, after the adjustment, the prepaid insurance account will show the correct balance of $2,300 on the balance sheet side, and the insurance expense account will report the correct amount of expired insurance that we've used, which is $100. So we see then that the balance sheet shows $2,300. That's 23 months of insurance that we still have left that we still need to use. And then we see for the income statement, we see that we've now used 1 month of insurance. We'll look now at how we do this. So now the general journal adjustment for December 31 and the general ledger account balances would then be as follows. So again, you would write, of course, you write the date, you would debit insurance expense $100 because you need to increase the expense, and then you would credit the asset, which is prepaid insurance, of $100 because that's what you used. Okay, so you debit insurance expense $100, and then you would credit prepaid insurance. And then you can put a note on there that says it's to record the first month's expired insurance. Fast Forward purchased $97.20 of supplies in December, some that were used during the month of December. So we go through our supply cabinet, we count up everything, and we realize that we still have $8,670 worth of supplies. So we know then that our beginning balance was $97.20. And then we figure out, okay, we take that, subtract from the beginning what was left. That gets us how much we used. And so we used $1,050 worth of supplies. So we know that we have $8,670 worth of supplies yet still to use. So that's what our balance sheet would show. And then our income statement would show $1,050 that was what you used for that 1 month. And so again, that's the T accounts, what it would look like, and then that's how you would record it. So on December 31st, then we are closing out the books for the year. And our business has only been in business a month, but that's okay. We're closing out the books. So we have to make our adjusting entries. So we see that December 31, supplies expense was $1,050, and then supplies credit $1,050 because we have to reduce the amount of supplies that we have. This is kind of a tricky one, but this is important. You guys have probably heard of depreciation, right? So for example, let's say that I'll tell you guys a true story. So I bought a car, and I bought it in 2015, and I paid a little over $15,000 for it. And it's a 2014 model. I bought it used with a little bit less than 10,000 miles on it. So it was practically a brand new car. To me anyway, it was. I still have it. How much do you think that car is worth today, if you were to guess? And I'll tell you what kind of car it is. It's a Ford Fiesta. How much do you think my Ford Fiesta is worth now? I paid right at $15,500 for it in 2015. How much do you think it's worth today?
I'd say like at least 1,500.
No, 8,000.
8,000.
Oh wait, what year? Sorry.
It's a 14.
Oh, it's newer. Just kidding. I'm used to old cars.
Okay, I'll tell you what. It ain't worth 8,000. I'll tell you that right now. It's worth maybe
3 to 4.
I'd say maybe about 3 to 4. I think
3
you're
to 4,000.
about right. Okay. I'm gonna say, wow, Mr. Abbott, he's cheap, huh?
Hey, no, that's cool.
So, but what I'm telling you is this, okay? I bought that car. It's now no longer worth what it was. In fact, when I drove it off the lot, they tell you it went down in value, right? I couldn't go back to Rosari and say, okay, I don't want my car and I want to trade it in now for another one. They're not going to give me back what I paid for it.
I have a question. So cars usually depreciate, but is there an instance where it can go up in value?
There is. Yeah, there is. I mean, if it's a classic car, it absolutely certainly can. And there certainly are some that absolutely. I mean, if you have you have like a classic muscle car or something, you fix it up, you restore it. It's maybe the only, there's very few of them now on the road, and it's nice, it's restored. Yeah, it absolutely could go up in value. Absolutely. But generally speaking, things as we use them, they're no longer worth what we paid for them. Or another example might be at Merced College, we buy computers, and we buy computers for our classrooms and the offices. We do that maybe every 4 years, maybe every 4 to 5 years, we replace these computers. Well, they get used up over that time, right? I mean, it's still sitting there, but we know that the advances of the technology are no longer the same, right? So we know that a computer that maybe we paid maybe $1,000 for maybe this year is obviously not going to be worth that in 4 years from now. It may only be worth maybe a couple $100s. In fact, true story, the computer, not the laptop I'm on, but I have a desktop computer. It's actually, it was a refurbished computer. And actually the monitor I'm using on that computer was too. Came out of maybe a bank, or it came out of a school, it came out of somewhere, and I bought it off a Newegg. Well, brand new, that computer was probably worth maybe $1,000. And I could buy it off a Newegg for, I don't know. I don't think I gave more than $200 for it. Of course, I've done some things to it to upgrade it so that it's still usable. Put a solid state drive and put more RAM in it so it still works. But then you find out things like, for example, for video editing, it will not run the program that I use, because the program I use is looking for certain kind of graphics capabilities that that computer only has a dual core Intel Core 2 Duo processor, doesn't have the proper capabilities in terms of video. So I have to use my laptop because it has an i5 in it. So things change. They're no longer, they have a certain useful life. And so we have to figure out how much we use over each time. So that would be depreciation, right? So there's different ways that you can figure this out. And so a special category of prepaid expenses is plant assets, which are long-term tangible assets used to produce and sell products or services. Plant assets provide benefits for more than one period. We expect, obviously, a computer or maybe a CNC machine or something, or a tire machine in a tire, like in a car repair shop. We expect that that's going to last for many, many years. So they'll be used for more than one period. It'll be used over a course. Again, examples: buildings, machines, vehicles, fixtures. Depreciation is the process of allocating the cost of a plant asset over its useful life in a systematic and rational manner. And usually the IRS, depending upon what it is, has guidelines for how you do this, okay? Depending upon what type of asset we're talking about. But at this point in the accounting process, we want to introduce you to the depreciation method known as straight line depreciation. Straight line depreciation is the most popular method used by companies. They determine the amount of annual depreciation by taking the cost of the asset, subtracting the estimated salvage value, and dividing the amount over its useful life of the asset. Now, the salvage value is the amount of the asset that we expect to receive for the asset when we dispose of it at the end of its useful life. And then later in the chapter, we'll talk about some other methods of depreciation. So for example, let's say at the college, we replace our computers every 4 years and we paid $1,000 for them. Maybe we figured out that maybe the salvage value of one of those computers maybe is like $50, because we're going to send it to some company. They're going to take them. We're going to maybe pull the hard drive out of it. They're going to take it. They're going to refurbish it, and then they're going to sell them on Newegg or something. And so for us, we're only going to get maybe $50 for it. So we figure that out, and then we figure out that the useful life of it is, I don't know, 5 years. So useful life. That is the period of time that an asset is expected to help produce revenues. Useful life expires as a result of wear and tear, or because it no longer satisfies the needs of the business. So for example, let's say you own a tire shop, and maybe you have the machine that they use to change the tires. That machine, every time you use it, you're putting wear and tear on that machine. And so eventually, it's no longer going to perform like it did when it was brand new. Or for an example, I talked about the computer, and I talked about my computer here at home that I use, which does everything else except edit videos. Well, if I was going to have to continue, if I didn't have my laptop and all I had was that computer, and I really wanted to use this certain program, and the program I use is called DaVinci Resolve. It's actually free, and it's similar to Adobe Premiere, but it's free. So I love it because it's free. Well, let's say that I knew I was going to be teaching online a lot more, and I knew that, and I only had that desktop computer. Well, if I can't use it to edit videos, it's no longer useful to me if that's going to be a major part of my business. So then, because we know things, as time goes on, things become obsolete. So that's how you determine the value. And usually they say, you know, for example, a computer, maybe it's only going to, we know that we're only going to be able to use it maybe 4 or 5 years, you know. A salvage value, as we said. Salvage value is the expected market value or selling price of an asset at the end of its useful life. Now, it could also be scrap value or the residual value. So for example, let's say it's a piece of equipment. You might not be able to sell it on to someone else. You may just have to scrap it. So for example, that tire machine, if it's broke down, it may not be useful to anybody, so then you just have to take it and you'd be able to get scrap metal price maybe for it. So that's something you'd have to think about. So let's look at depreciation. So fast forward, purchased equipment on December the 1st for $26,000. It has an estimated useful life of 5 years. And the equipment is expected to still be worth about $8,000 at the end of 5 years. And so they purchased the equipment on December the 1st, and here we are now, December 31st, for closing out the books. Now, because Fast Forward expects the equipment to be worth $8,000 when the 5 years is over, only $18,000 of the cost needs to be spread over the next 60 months. Remember, 60 months is 5 years. So we do a little bit of arithmetic, and we figured out that the original cost was $26,000. We realized that the salvage value was $8,000, so then the net cost of it is $18,000, and $18,000 is the part of it that we will depreciate. Step 2 then is we want to figure out and convert it then to months. So if we take $18,000 and we divide that by 60, because 60 months in that 5-year period, we know that you're going to be able to take $300 a month for the depreciation of this equipment. Then this is how we would do that. So we would initially on December 1st, when we purchased the equipment, we would debit equipment $26,000. And then on the 31st, then what we would do is we would debit the depreciation expense for $300, because that's the amount of it that we've used. And then we would credit the accumulated depreciation. And you'd use this accumulated depreciation instead of doing anything with the equipment. You wouldn't do anything on the equipment account. And so again, when we write our journal entry, it would look like this. So December 31st, depreciation expense, $300, and an accumulated depreciation of equipment for $300, and that records the monthly equipment depreciation. Now again, just a note, accumulated depreciation is a contra asset account. This is the first time that we've seen a contra account, but it will not be the last. A contra account is an account linked with another account. It has an opposite normal balance, and it is recorded as a subtraction from the other account's balance. In our case, accumulated depreciation will reduce the asset account equipment. Because this is a new type of account, let's look at the treatment of contra and related asset accounts on the balance sheet. The contra account accumulated depreciation will be shown as a reduction in the cost of the asset equipment. Cost of a plant asset less accumulated depreciation is known as book value. So the asset equipment will be shown on a balance sheet at its net amount or book value. In the partial balance sheet that you see here on this slide, 3 months of accumulated depreciation have been taken on the equipment for a total of 3 times 300 or $900. The equipment account is being reported at $25,100, which is the cost that has not yet been depreciated. Because the contra account appears on the balance sheet, it will not be closed at the end of the accounting period. It will be carried forward to 2021 and used to accumulate the depreciation related to equipment. So this account, it keeps going. So because it's not closed out at the end. So it's one of these ones, it's what they call a permanent account, and that it's not going to be closed out at the end of the period. Deferral of revenue. Okay. Unearned revenue is cash received in advance of providing products or services. So an example, let's say an insurance company, let's say State Farm Insurance. sometimes you have to pay, let's say that you pay your car insurance up and you pay it for 6 months and you pay it in advance. Well, that's to them, that would be, to that company, that would be unearned because they haven't provided the services yet on it until 1 month passes, and then the next month passes, and so on and so forth. So for example, actually with my car insurance, how it works is it renews every 6 months, but they have it set up where we make payments for 5 months out of that 6-month period. And so there's always 2 months out of the year that we don't have a car payment to make. And so part of each month's payment then would be unearned because it is for payment for the next month, basically. Okay. So when accounting for deferred revenues, we are faced with a transaction where cash is received in advance for providing a product or service. In other words, we have received the cash but have not done anything to earn it. In our example, we will examine accounting for the receipt of cash prior to our company rendering any services. So when we render accounting or consulting services, we will prepare an adjustment for deferred revenues, which is a liability. We will always debit or reduce a liability account and credit or increase an expense account. Fast Forward's client paid 60 days fee in advance, covering the period from December the 27th to February the 24th. And so that initially is recorded as follows. We debit cash in the amount of $3,000 because that's what we received. Now, we haven't done anything yet. So we've not done anything to earn the revenue. So rather than crediting it to sales revenue, we credit it to unearned consulting revenue because we received advance payment for services. So now Fast Forward earns payment as time passes. At 12/31, 5 days service is earned, or 5/60th of the 3,000, which is 250. So we have to do an adjusting entry that reduces the liability of unearned consulting revenue by 250 or 5 days worth of revenue. And then also consulting revenue of 250 is earned. So let's look at that. So we see here that we had unearned consulting revenue of a credit of 3,000. We've now earned 250 of it. So then that leaves 2,750 balance of revenue that we've not earned yet. And so that's on the balance sheet because that's a liability to us. And then on the income statement, then we have consulting revenue, and we had a balance there previously, and then we've earned from prior work, and then we've earned this $250. So we add both of those up, and so now our balance is $6,050 of revenue that we've earned. And so this is how we would go ahead and record that, is we would go ahead and debit the unearned consulting revenue 250 because now we've earned it, so we want to reduce our liability. And then we're going to credit consulting revenue 250 because that's what, to show then that we've earned that revenue, and that is part of equity. So we see here to record earned revenue received in advance. Now we're going to talk about preparing and explaining adjusting entries for accrued expenses. So now, accrued expenses are costs incurred in the current period that are both unpaid and unrecorded. So for example, when you use your credit card, often you do not record a transaction until you pay your monthly invoice, even though you've incurred the cost. Accrued expenses are reported on the income statement of the period when incurred. Examples of accrued expenses are salaries and interest. For all accrued expenses adjusting entries, we debit or increase an expense account and credit and or also increase a liability account. So let's look at an example here. Fast Forward pays its employees $70 per day or $350 for a 5-day work week. Salaries are paid every 2 weeks on a Friday. So 12/31 is a Wednesday, so 3 days salary are owed at year end, which equals $70 times 30 equals 210. So they've paid the previous Friday, and then they worked Monday, Tuesday, and Wednesday. So they still have to work Thursday and Friday. But Thursday and Friday would happen in 2020, for example. So in another year. So we have to indicate how much we owe from the previous year. So we got to close when we go to close out the books. So the adjusting entry increases the liability, which in this case is salaries payable, and then also increases the salaries expense account by 210 with the following entry. So we will debit salaries expense for 210, and we will credit salaries payable 210. And that records the 3 days of accrued salaries. So after the adjustment, we see that salaries payable has a balance of 210, and that's on the balance sheet. And then on the income statement, we add to what already was there salaries expense of 1,400. We add to that by using a debit 210, and so then our expenses for the year were $1,610. Fast Forward recorded accrued salaries of 210. Now, on January the 9th would then be the first payday of the next period. The following entry settles the accrued liability, the salaries payable, and records salary expense for 7 days worth of work in January. The $210 debit reflects the payment of the liability for the 3 days salary that was accrued on December the 31st. The $490 debit records the salary of January's first 7 working days, including the New Year's Day holiday, as an expense of the new accounting period. The $700 in cash credit, that then records the total amount of cash that was paid to the employee. And notice there too that we included New Year's Day, because some businesses, they do work on the holiday, but also too, if it was, let's say, a paid holiday, then they're still getting paid for it. So we do include that. So accrued revenues are revenues that are earned in a period that are both unrecorded and not yet received cash or other assets for. So the adjusting entry to accrued revenues is needed because many firms have delivered a product or provided a service but have not recorded the revenue in the current period. In our example, a company completes a consulting engagement. The company has earned the revenue but has not recorded it at year end. The company has earned interest that has not been paid until the next period as well. So the adjusting entries to record accrued revenue will always debit or increase an asset account and the credit and also increase a revenue account. So let's look here. We see that on December the 12th, Fast Forward's customer agreed to pay $2,700 on January the 10th of the next year for future services over the next 30 days. On December the 31st, 20 days worth of services have been provided and earned with a total of $1,800. So again, $2,700 times 20 divided by the 30 days. So then we do our adjusting entry. So we've now they agreed to pay $2,700. They've not paid that yet. And so far, we've done 20 days worth of work for them, which works out to $1,800 so far. Debit accounts receivable, $1,800, because accounts receivable, remember we talked about, is an asset. We want to increase on that. And then the consulting revenue, $1,800, we will credit that because that is an equity, and we want to increase on our equity because that's how much to recognize the revenue that we've earned. We have an adjustment debit of $1,800 for on the balance sheet for accounts receivable, which again, as I said, is an asset. And then we credit for the consulting revenue, the $1,800, to add to the revenue that we've already earned. So we already earned previous to this $6,050 of revenue previous. We're adding now, adjusting for the $1,800 of revenue that we've generated but we haven't received yet. We're going to go ahead and add that to the total. So then we see then $7,850 is the balance for consulting revenue on the income statement. This is what that we recorded the revenue. Now, let's say now we've been paid now by our client. So the accrued revenue at the end of one period results in a cash receipt in a future period. So on December the 31st, Fast Forward recorded accrued revenue earned of $1,800. Okay. So they had earned that revenue, and that's what they recorded at the end of their fiscal period, was $1,800. So now on January the 10th of the next year, the following entry will reduce the accounts receivable, record revenue earned for 10 days, and the receipt of the $2,700 of cash. Because we've already recorded 20 days of revenue to consulting revenue, we now have to record the 10 days that we did in January. So we see here, we debit cash $2,700 because that's what we've received, and then we will credit accounts receivable for $1,800. That's accounting for the 20 days of work that we've already done, and so that will then go ahead and clear that out for what, because we're receiving that payment. And then also then we will credit for $900 the consulting revenue for, and that represents the 10 days of work that we did in the new year. We see here this summary will prove very useful when completing your homework or studying for the next exam. Here is how we read this table, and this should be figure 312 in your textbook, or you can I believe you can download the slides from the viewer in Canvas. If not, you can send me an email and I can send you the PowerPoint. You can, that way you have the PowerPoint file and you can just print this slide out. But here is how we read this table. Before we adjust a prepaid expense, the asset of the company are overstated and the expenses are understated in the current period. The proper adjusting entry is to debit or increase an expense account and credit or decrease an asset account. Remember that each adjusting entry affects one or more income statement, either revenue or expense accounts, and one or more balance sheet, which would either be asset or liability accounts, but never the cash account. Take a few minutes and go over the remaining 3 types of adjusting entries before moving on, when we will use a spreadsheet to prepare the adjusting entries and financial statements. So moving right along, adjusted trial balance. So we see here now, this is the adjusted trial balance then for Fast Forward. So an adjusted trial balance is a list of accounts and balances prepared before adjustments are recorded. An adjusted trial balance is a list of accounts and balances prepared after adjusting entries have been recorded and posted to the ledger. Here we show both the unadjusted and the adjusted trial balances for Fast Forward at December 31 of 2019. The order of accounts in a trial balance is usually set up to match the order of the chart of accounts. Several new accounts arise from the adjusting entries. Each adjustment, see the middle column, is identified by a letter in parenthesis, and that links to an adjusting entry explained earlier. Each amount in the adjusted trial balance column is computed by taking the account's amount from the unadjusted trial balance columns and adding or subtracting any adjustments. Next, we will look at how to prepare financial statements from the adjusted trial balance. So again, you see here, for example, we look here, accounts receivable. At the beginning, they didn't have any. Then they added 1,800. So then we see then that would be what the adjusted balance would be. Okay, so we see here how we do that, and that's how. So what you're going to look at when you go to actually do your financial statements is, and I'm just going to mark, what you're actually going to look at then is going to be the adjusted trial balance. That's the piece of this that you're concerned with. So it's the part that I'm putting the red rectangle around. Preparing financial statements from that adjusted trial balance. So the first thing then with this is we can prepare financial statements directly from information in the adjusted trial balance that we looked at earlier. An adjusted trial balance includes all accounts and balances appearing on financial statements, and it's easier to work from than the entire ledger when preparing final financial statements, because you can just look at that, you can just see the balance that's there, and then just copy it across. Then there are different steps. So the first step is to prepare the income statement using revenue and expense accounts that are from the adjusted trial balance. Remember, we start with that first because we need that in order we need the income statement in order to be able to do the owner's equity. So then we'll prepare the statement of owner's equity using the capital and the withdrawals from the adjusted trial balance, and you'll pull the net income that you got from the income statement. And then you'll prepare the balance sheet using assets liability accounts from the adjusted trial balance. You'll have to pull the adjusted updated capital balance from the statement of owner's equity that you did previous. Finally, you'll prepare a statement of cash flows that shows the changes of cash flow in the period, and we'll talk about that later. We're not going to discuss that at this point. This gives you an idea here. So you have the adjusted trial balance, and then you see here balance sheet, the statement of owner's equity, or and in the income statement. So let's talk about the income statement first, because you have to prepare that first. So we look at revenues, and so we get the consulting revenue, rental revenue. We just simply list those, and we get a total. And then we have our expenses, and we look at the expenses here. We list them out, we get a total. So we take our revenues, subtract the expenses, we get our net income or net loss. And then what we do is we take that, we go up into, we look at our statement of owner's equity. So we look at the adjusted trial balance, and we see C. Taylor Capital. He didn't have any on December 1st because it's a new business, but he invested $30,000, and we get that again from the trial balance adjusted. And then we get the net income. We get that from the income statement. We plug that in, and so we get the total there for the additions of owner's equity, and then we subtract how much was taken out, and that gets us the final amount for capital. And then finally, then we can go ahead and prepare the balance sheet. We can look and just simply copy over the amounts for our assets. And then we notice here equipment, and then we have the depreciation amount, what was used up. So that's how much of the equipment we still have on our books. We add up all of those. Same thing with our liability, we just copy those over. And then we have equity, C. Taylor equity. That should be the amount that we figured out here on this statement of owner's equity. And then we'll get that, and then that we can then figure out then the totals of our liabilities and our equity. And then we see then that both of these in fact do balance. So we know then that everything should be done correct. But for right now, we're going to kind of set aside this. So we're done with doing adjusting entries for the moment. But we're going to talk now about A1, which is computing the profit margin, and how to use that to analyze the company's performance. And there is, I believe, on the problems, maybe it's on the exercises, but I do know you have a question about this, about figuring out profit margin. So the profit margin ratio measures the company's net income to net sales. So profit margin is net income divided by net sales. So the profit margin is an important measurement in business. It tells us about the relationship between sales and profits or net income. We calculate the ratio by dividing net income for the period by sales revenue. A high profit margin is an indicator for future growth. And so, and of course, they're going to talk about Visa and MasterCard. And we know, obviously, a credit card, they're going to have a pretty good, healthy profit margin. Usually, businesses, I would say if you have a 20%, that's pretty good. You're not going to have, there's some businesses like, for example, a grocery store, that their profit margin is not going to be, definitely not going to be as high. Because, again, all of the costs for the food that they have there, all of the cost for labor, their cost of utilities, building, etc., all of that, they break even and they make money, but they don't make as much as what you might ordinarily think that they do. But of course, a company like this, where it's like a credit card company, of course, they're going to make a lot of money because of the interest that's charged. So in the example here, we see that they had, and again, these are in millions of dollars. We're looking at the current year. We see that probably be billions, so almost 6.7 billion of income, and then they had sales of 18.4 almost billion. So that works out to that they had a profit margin of 36% in the case of Visa. That's compared to about 31% for MasterCard. So you can see that. But you can see that Visa is obviously, the profit margin is quite a bit higher than what it would be for MasterCard. And so for MasterCard to improve its profit margin, it has to either reduce expenses or it has to increase revenues to a relatively greater amount than the expenses. But that allows you, in order to compare, let's say, two businesses that do a similar thing. So both Visa and MasterCard, we know, are both credit card companies that provide the processing and the credit card infrastructure. So they both are in a very similar business. Obviously, one is definitely, probably Visa is definitely more popular than MasterCard. So, and again, and obviously they have different expenses, different things in how it is that they run their business. But the profit margin, that's one thing you can figure out. You could use to compare to figure out, okay, which one is doing better in terms of their profitability. All right, and then we're going to talk about, this is Appendix 3A, it's talking about an alternative accounting for prepayments. So an alternative method is to record all prepaid expenses with debits to the expense account, which is not how we, or that is, I think, that's not how we talked about. So if any prepayments prepaid remain unused or unexpired at the end of the accounting period, then adjusting entries must transfer the cost of the unused portion for the expense to the prepaid expense asset accounts. This alternative method is acceptable. The financial statements are identical under either method, but the adjusting entries are different. To illustrate the difference between these two methods, let's look at Fast Forward's cash balance for December the 6th for 24 months of insurance coverage beginning on December 1. Fast Forward recorded that payment with a debit to an asset account, but it could have recorded a debit to an expense account. These alternatives are shown on this slide in the first graphic. So we see here that what they did was they did prepaid insurance $2,400 and in cash $2,400, because that's when they first purchased the insurance. They could have done it, instead of to prepaid, they could have done it to insurance expense $2,400 and in cash. $2,400. And then at the end of the accounting period, which would be the end of the year, December 31, insurance protection for 1 month had expired. This means that $100 of insurance coverage has expired and is an expense for December. The adjusting entry depends on how the original payment was recorded. And this is shown in the second graphic in the red or whatever color this is. So we see here that if you did it this way, prepaid insurance and cash, you would have to do it as insurance expense $100 and then prepaid insurance $100, because that increases the expense and it decreases the asset. Now, if you did it previously, when you purchased it like this, insurance expense $2,400, cash $2,400. Then when you go to record the expense, you would have to debit the prepaid insurance $2,300 and then credit the insurance expense $2,300. And then we see on the next one here, we see then that basically it's going to work out the same. So we see here that prepaid insurance is going to end up with a balance, if you record it to the asset, of $2,300. And then over here, if they recorded it as expense, you're just going to have that same balance. And then the insurance expense, what was used in that accounting period was $100. And then we see over here, it works out to the same. So either way, you could actually do it technically either way. And then also with revenues. An alternative method is to record all revenues to a liability account or a revenue account. So if you record it as a liability, you have cash of debit cash $3,000 and then credit the unearned consulting revenue for $3,000. Or you could do cash for $3,000 and then just go ahead and record it directly to consulting revenue. And then the adjusting entry would be like this. So if you recorded it as a liability, then you would have to do unearned consulting revenue debit for $250, and then you'd have to credit the consulting revenue for $250, because that shows how much of it that you earned. Otherwise, you would have to do it like this: consulting revenue $2,750, unearned consulting revenue $2,750. And we see here that you're going to come out the same way in terms of your balance. It's just the only difference is just when things are recorded.